Bill, let me start with you. Always good to gauge your level of worriedness about something like this. Are you seeing these restrictions on withdrawals and the likes and feeling like something is on the horizon here, something worth us noting?
Well, David, maybe I'm like the boy who cried wolf a few times, but we are overdue, shall we say, for some sort of financial correction, right? Usually, as a Wall Street historian, usually these things happen once every 20 years or so. So it's been 18 years, right? So we're probably due for something. So that feels like maybe something is imminent, but I don't think this private credit is going to be the catalyst. I think this is a big overreaction, frankly. I can elaborate.
Please.
Okay.
I was going to prod you to do so, but go ahead.
So, I mean, let's think about this. If we're really, like, if you create a fund and you say people can only take out 5% of their money, every quarter, and you're a retail investor and people start making noises about being worried about software credit or something like that, and your broker says, well, maybe you really should think about taking money out. Of course you're going to take money out and ask questions later. So everybody floods to that, and then it becomes headlines that, more than 5% people are seeking redemptions, and everybody's starting freaking out, and it's contagious. But what are we talking about here? We're talking about basically 97% of the securities in these funds, or private credit generally, is senior secured debt. Okay, senior secured debt, top of the food chain. If we want to be worried, we should be worried about the equity down at the bottom of these companies or these leveraged buyouts or whatever these credits are. Nobody seems to be talking about their concern about the equity.
No.
If you're going to be worried, let's worry about the equity holders, and then maybe down the road we can worry about the senior secured
As
credit.
a millennial, I'm more worried about another financial crisis. Thanks for that. But Dani, you were nodding when he was saying equity. Yeah. Talk to us about why that's a concern.
I mean, this is, I have to say, I've heard this argument a lot, and I think it makes complete sense, just given where the capital stack exists, where credit exists. That's going to get paid out first. You have to worry about the equity if a loan is going to zero. It's something that I have to say Blue Owl makes the argument of quite frequently, and it's completely fair. Also, if you're in a credit cycle, what's happening to the equity market? What's happening to public equities if you're in the middle of a credit cycle? So it's not just private credit, and I think it is important to contextualize how big this universe is. It's just under $2 trillion. The BDC, these retail funds, are even a smaller amount of it, and most of these funds gate them at 5%, so only 5% of those even smaller funds are coming out. It's something that John Zito from Apollo has said, if you can't meet these redemptions, I think he said something along the lines of like, you're a fool, not exactly that, but basically saying they amount to a rounding error for us, the amount of money that's being pulled out. Look, that doesn't mean that there aren't issues, especially for specific funds that have essentially built themselves around these being the profit drivers for them or the future drivers of growth, but it's not necessarily systemic.
Bill giving us this hypothetical, the retail investor calling the broker and getting nervous. I think a lot of people seized on Jamie Dimon's kind of markets entomology a few months back when he talked about cockroaches. I mean, it's something very vivid that a lot of people seized on. Again, you've been tracking bank earnings over the course of the week. What have bank executives said about what is effectively one of their rivals? I mean, they are taking business away from some of these major banks.
I don't know if you got this too, but it felt kind of like a pullback from Jamie Dimon. He wasn't as forceful when he talked. He didn't bring up cockroaches or anything like that. And in fact said that if we have some sort of crisis, I don't think that private credit is going to be the thing that causes it. And by the way, any ruptures in the business, to your point, is good for these banks. I mean, they do have exposure. JP Morgan has about $50 billion, which they laid out. But broadly, syndicate markets get a little bit more popular when you start to see pullbacks on private credit. You have started to see there was really intense competition. It still exists, but it feels like it's ebbed a bit.
So go ahead.
I mean, what are we really talking about here? We're talking about loans that banks have been making for generations, for millennia. So Jamie Dimon is like one of the biggest lenders that there is. So he's in the private credit business. Yes, because after Dodd-Frank, after the 2008 financial crisis, Gary Gensler and his fellow regulators, wanted to push that kind of business off the books of the central banks, the big banks on Wall Street. They became in the moving business, not in the storage business. So what happened? around all of that new regulation, up comes, the Apollos, the Blackstones, the KKRs, the Blue Owls, all of them who are the sort of private credit leaders. And by the way, that business took off. They all used to be just private equity guys. Now all of a sudden they're private credit guys, or they're alternative asset management guys. They're all in the same business. They're all doing the same thing. And they're all sort of filling the hole that was left by when GE Capital went out of that business in 2015. So they're all making loans to, inventory finance or mobile home finance, or things that basically nobody really wants to do, but they're senior secured at the top of the credit structure. And so what are we really worried about here? Yes, it's great headlines, and it's fun to see people want more than 5% of their money out when, they can only take 5%, they want 7.5%. What do we do? Do we put more money in, or do we gate them? What do we do? So it's an event, but...
All right, we've got about 2 minutes left. I'm going to start with you, Bill, then I want to go to Dani. If we're not worried about private credit, what are we worried about?
It's an impossible question. You know that, Christina.
What is keeping you up at night?
Well, again, I think human nature is such that people forget the last
short memories.
So I'm worried about the excess valuation, the toppiness to the valuations. The AI. We all talk about AI. AI is probably going to be revolutionary, but valuing these things at infinite multiples of earnings. It's bound to come down, but shorting them is a very dangerous game too. So.
Dani?
I'm worried kind of on the existential AI thing and what it means for our labor markets. I know that's completely feels non sequitur to what we're talking about. But to be fair, it is part of the ruptures we've seen in private credit. We've seen kind of trickling in companies talking about layoffs because of AI. It could be a little bit of AI theater, but are politicians prepared for this? We've seen backlash in communities about building data centers, which, by the way, private credit, that's been a huge business for them. I feel like we're moving towards something, and we haven't fully thought out what that end game looks like from politicians, regulators, and even capital markets and valuations. I feel like we're kind of putting the plane together as we're flying, and that worries me a bit.
And no one rings a bell at the top of the market.
No.
And no one, very rarely can you anticipate the crisis that's going to occur until it occurs.
Bill Cohan, you're going to come back here in a bit. You've got a new movie out,
Yes.
a book on the way, plenty
Yes.
to talk about. We'll get to that in a few minutes.